We are entering an inflationary period that we haven't seen for a long time. In the US, inflation is at 8.6%, which is the largest in over 40 years. In Europe, the ECB measured inflation to be 8.1%. In this video, we'll talk about if the Fed is doing enough to fight inflation and why it may be difficult to control inflation, and also the effect that this is having on the markets. And we'll even talk about the S word. The main reason why we're seeing so much inflation right now is due to all the stimulus and money creation over the past few years. Since the pandemic, $12 trillion has been added to the economy. This is a 30% increase in the money supply over the past couple years. So all this money that was put into the economy ultimately led to more spending, just because as humans we're rational actors, and given more disposable income, that means that we're going to spend more money. Now, given that there is an increase in spending across the economy, this means that there's a higher demand for products. And a higher demand for products means that there's going to be higher prices. Now, this is the first inflationary pressure. So that leads right into the second point. Due to this higher demand, all of a sudden there's a larger supply that's being requested to meet these demand requirements, which is putting the first test on the supply chains. And then you couple this with the COVID-19 lockdowns, which just slows everything down. And then you take China, for example, who's the largest producer and exporter of goods in the world, who's still experiencing lockdowns today. This has caused a total slowdown of logistic and supply chains across the globe. So at first you had high demand, but now you have less supply. This is inflationary pressure number 2. And it doesn't stop at 2. There's actually a third inflationary pressure to come that we'll discuss a little later in the video. But let's look at how this is impacting the markets. So far this year, the S&P 500 is down 21%, while the Nasdaq's down 31%. On the other side, we've seen treasury bonds almost double since the start of this year. The market senses that inflation could stay here for a little while, and that there are future rate hikes, and that's going to lead to the next recession. Well, the expansionary policy that was ran during the pandemic led to inflation. We now need contractionary monetary policy to rein inflation back in. Higher rates are going to slow economic growth. They're going to hurt employment numbers, and they will put us in the next recession. But to me, it's not a matter of whether there's going to be a recession. It's a matter of how bad and how long will this recession be. And it's my opinion that the answer to that question will be determined by how quickly we can get inflation under control. Now let's draw back to that third inflationary pressure, and it has to do with Putin, sanctions, and the war in Ukraine. Now, Putin is not the reason why we're experiencing inflation today. It's due to rapid money creation during the pandemic. However, moving forward, this war could create further problems to helping get inflation under control. And that is due in large part to gas prices. Gas prices are already astronomical, some of the highest that we've ever seen. And now considering that Russia, who's one of the major gas exporters, has been cut off by the West, gas prices may not recover. And gas prices are important to the overall economy because they have to do with transportation costs. Any tangible product that is going to be exported or transported is going to require gas, and the price of gasoline going up is going to impact prices across the entire economy. So these are the 3 inflationary pressures, and they're just creating a vicious cycle to make inflation even worse. So that's why I believe the number 1 priority of the Federal Reserve should be to get inflation under control. I'm concerned that the Federal Reserve and the ECB in Europe are moving too slow in their efforts to fight inflation. In Europe, the ECB raised rates, but still rates remain around 0. And it was a good sign that the Fed raised by 75 basis points, but still I believe that this is too slow and that they should raise more aggressively in the future. If we're going to tackle inflation, we need to get ahead of it. Otherwise, we'll end up just keep chasing it. And as the rates rise, this will hurt the economy. It will hurt growth. It will hurt employment. But if we're not raising enough, it's going to cause this pain to the economy while not getting inflation under control, which will lead to that S word, stagflation. As this economic storm that's coming in, it looks pretty bad and scary. I do feel that there are a few bright spots that I want to touch on, so it's not all doom and gloom. The first being gas prices. Just recently, the Saudis agreed to increase their production, which could give some ease to the rising gas prices. And also in the United States, we haven't seen this yet, but the Biden administration could agree to ramp up production. The second bright spot is that the economy was in a strong state prior to the pandemic, which means that, well, it wasn't like a bubble was just building up over the past decades that's now bursting. It's that we delayed the economic fallout, and now we're about to experience it. And the third, from the stock market perspective, they've already begun to price in a lot of this doom and gloom. I'm not saying that stocks won't go lower, but a lot of this bad forecast is already baked into the stock market. So on the bright side, it's possible that stocks don't go too much lower, even though there could be hard economic times ahead. Thank you guys for watching to the end. If you enjoyed this video, please consider subscribing to my channel. We'll make more videos like this in the future. Thank you.